Yeah.
Good afternoon, everybody. So we still have some things to do before we move to stock valuation. Two things still to talk about: bond valuation. The first one we started last time, but we didn't finish, and then we have the term structure. So we ended the class last time talking about the APR, annual percentage rate, which is also the bond equivalent yield. When bonds are repaid every 6 months, which is usually the case in the US bond market, the yield to maturity, the implied discount rate, is computed in semi-annual terms based on the frequency of the payment. What the financial press does is taking this semi-annual yield to maturity and multiply this by 2 to get an annual measure of the yield to maturity. And it calls it APR, annual percentage rate, or bond equivalent yield. I asked you last time what kind of a measure, a rate, is APR. Is it a nominal rate or effective rate? So let's figure out by an example. I think this was the example. Face value is $1,000. The maturity is 1 year. The coupon rate is 6%. And the frequency of the payment is every 6 months. So we have all of the 4 parameters here, so we can schedule the payments. So we have 0, 1 year, 1 year, and this is 6 months. So we have $30 and 1,000. Face value plus $30 the coupon payment, right? Any question about how to schedule these payments? Okay, so let's, for very simple case, we'll assume that the current bond price is $1,000. Okay, just to illustrate the point. What is the yield to maturity, the semi-annual yield to maturity of this bond? How do I find the yield to maturity? What is the method to find the yield to maturity? The yield to maturity is the implied discount rate of the bond, right? So I need to write the formula of the bond pricing, where I have the bond price on the left-hand side, this is B, equals to the present value of the bond payments. Remember that? This is the face value of the bond payments. And the R that satisfies this equation, this is the yield to maturity. Because we have payments every 6 months, it will be the 6 months yield to maturity. So how do I find R here? What do? We need Excel, right? Like we did an exam, right? But without Excel, can you have a guess? If I put this in Excel, what will be R? Yeah? It will be 3%. Correct? Yes. Why? Because this is a power bond, right? Remember, when the face value, when the discount rate equals to the coupon rate, then the face value equals to the market value of the bond. Remember that? We had also an example. And this is exactly the case. As an exercise, you can put it in Excel and find that R equals 3%. Okay? Which means that the yield to maturity of 6 months is 3%. Okay? You can check it out. It's an exercise in Excel. Okay? Now, what the financial press does is taking this 3% and multiply it by 2 to get 6%, and it's called the APR. And this is the annual measure of the return on the bond. So the question to you is APR nominal or effective? What do you think? If you invest $1,000 for the year, and after 6 months you get 30%, sorry, 3%, $30. And then after 6 months, additional 6 months, you get another $30 and the original investment. Yes? Why? Because it doesn't take into account the reinvestment, right? The interest on interest. Let's see. What will be the value of this investment after 1 year? What will be the value of this investment? 1,000 times 1.03, which is 1,030, right? This will be how much you're going to make, right? 3% every 6 months. What does it mean 3% every 6 months? But after 1 year, the value of the investment is 1,000 times 1.03. And after 2 years, what will be the value of the investment? 1,030 times 1.03, which we can write 1,000 times 1.03 square, which is $1,060.09. Where is that 9 cents coming from? 3% on the $30 that you got already early from the bond. So what will be the effective rate? The effective rate will be 1 plus 0.06% over 2, which we get the 3%, with a power of 2 minus 1, which is 0.0609. More than 6%. 6.09%. Okay? And this is the effective rate. Now, is this formula familiar? Yes.
I just have a question.
Yeah.
Why after 1 year is it 1,030 and not 1,060? If it's semi-annual, you get the two $30 payments twice.
You get the $60, but in 2 periods. You
Right.
get $30 after 6 months and the 30 after 1 year. But because you have in hand $30 early, you can reinvest it and not at 3% every 6 months. So you get another 9 cents, right? Because the first class, money worth more if you get it earlier, right? So it's totally different if you get a $60 at the end of the year, or 30 after 6 months and 30 after 1 year. This is better. Effectively, you're making more because the interest on interest. Right? Now, is this formula looks familiar?
Yeah,
Where?
it's the same one that we did at the end of the present value chapter.
Excellent. This is exactly a simple example of the conversion formula, the general conversion formula from nominal rate to effective rate, where M, remember, equals 2 in this case. What was the conversion formula? How do we convert nominal rate to effective rate? R effective equals 1 plus R nominal over the number of payments every year with the power of number of payments minus 1. So here is a simple example where the number of payments is 2. And this is called the effective annual yield, which is the effective rate for the bonds. With semi-annual compounding, the effective annual yield is 1 plus the APR, which is this, remember the 6%, over 2, with the power of 2 minus 1. Okay? For semi-annual bonds, if the bond is repaid every quarter, then it will be 4, the number of payments. If it's repaid every month, it will be 12. But in general, bonds are paid every 6 months, so this is a very useful formula. And the example here is just what we did. Okay, so when you see APR in your mortgages or your bank offers for rates, look at the number of payments every year, because the APR is nominal. Okay, and what you want to look at is the effective annual yield. Make sense? Any questions? Okay. The last thing that we're going to talk with regards to the bond pricing is the term structure of the interest rate. So far we assume in all of the examples that we did and the formula that we presented that the discount rate, the interest rate, is the same for every period. Okay? If we have payment after 6 months, or 1 year, or 2 years, and 3 years, it was the same R, annual discount rate. Okay? But in practice, it's not the case, usually. What does it mean? How do we know what is the interest rate in the market, the risk-free rate? If you want to know what is the risk-free rate, what do? Yes?
Do you check the yield on a government bond?
Exactly. You go to the government, that's what we said in the first class, right? If you want to know what is the risk rate in the market, you go to the bank or the government bonds, you look, what is the return over there? So you look at the payments that they have, usually, let's say 0 coupon bond for 1 year. What is the price now? You do the calculation, I'm going to make 2% on that. So this is the risk-free rate in the market, right? So you can do it for 1 year T-bill, right? What if you do it for 2 years bond? And you calculate the annual discount rate. You make it 2%, but maybe you're going to get a different number, right? Maybe it's 2.4%. So now wait a minute. We say the government offers an investment of 2% for 1 year and 2.4% a year for 2 years. So what is the annual interest rate? 2% or 2.4%? The answer is that there is no one uniform interest rate. It depends on the horizon. Okay, and this is called the term structure of interest rate. Okay? So if someone asks you what is the current risk-free rate in the market, your answer should be a question. To what horizon? right? And this is how it looks. So this is from maybe 2 weeks ago or so that I just put it out from the Department of Treasury website. If you look at 1 month, the yield to maturity in annual terms, everything is in annual terms. The annual rate based on 1 month's T-bill is 2.49%. For 2 months, 2.79, 3 months, 2.94, everything in annual terms. So it's going up. Then it's going down a little bit, up, down, up, down. Generally it goes up. Even not monotonically. Okay? So this is called upward sloping term structure of the interest rate. Okay? Or upward sloping curve. Or upward sloping yield curve. Okay? Usually it's upward sloping, although not monotonically, and the reason is it's not risky because it's risk-free, right? But it depends on the demand and supply. Okay, what does it mean? If it's easy for the government to find more buyers for 1-year loans, so then the government can increase price a little bit, right? So the yield to maturity will be lower. If for 20, 30 years it's more hard to find demand for the governments to buy the bonds, so they need to reduce price a little bit. So then the yield to maturity will be a little bit higher, right? But the important point here is that it's not constant. Okay? Any questions? Any question about the term structure of interest rate? Any question about bonds in general? Okay, so now we're going to move to stock pricing. Okay? Okay, stock valuation. So, after developing the valuation tools in the first week, we said that the price of an asset and the project, the general future cash flow will be given by the present value of these assets or project. And this applies also to financial assets, bonds, and stocks. So the first thing that we did is implementing the valuation tools to bonds. And now we're going to do the same for stocks. Okay, how do we price stocks? So before going directly to the stock valuation mechanism, let's say several key points about stocks. Okay? So first thing, stocks represent ownership. The stockholders, the equity holders of the company are the owners of the company, not the bondholders. The bondholders give loan to the company. But the claimants that control the firm are the stockholders. They are the owners. And as owners, they make all of the decisions concerning the firm's operation. Right? So give me an example of decisions that are made by the owners, the stockholders. What kind of decision owners make? Owners of business. Yeah? Yeah, of course. Going public, right? Taking the company to the stock market. You went public, what are the decisions? Remind me your name? Trez. What other decision can be made? Yes?
How many dividends?
How to pay, what to do with the profits. Paying dividends, repurchase stocks, reinvest in the company, right? Any decision you're gonna say, it will be the right answer because these are made by the owners. What else? Remind your name? Ali. How to raise capital. We need some financing to finance some projects. Should we go to the to add more owners, to issue more stocks? Maybe taking loans, right? How to take loans? Private debt, banks, maybe the bond market, public debt. Of course, these decisions are made by the owners. What else? Yes?
Stock splits.
Stock splits, right? If the stock's going Tesla, last May was $900, right, a share, and they split 3 to 1 to 300, right? Who made the decision? Tesla's owners, right? Yes. What else? Yes?
What's the with employee size? So whether it's like high more employees or low people are.
Hire employees, hire CEO, firing CEO, right? Hiring, firing, deciding about project, which project to take, how much to invest in research and development, right? Anything that you can think of, all of the decisions are made by the owners. And as owners, the stockholders have voting rights. And the voting rights are usually proportional to the percentage of the owners in the company. Meaning that if you own 40% of the company, you're going to have twice as much as voting rights than someone that owns 20% of the company. Okay? Now, it doesn't mean that every stockholders will have a say, right? It applies only to the major shareholders. Okay? So not everyone just bought a stock of Microsoft will vote. But if you're a major shareholder, like usually 5% and up, then they will ask you what is your vote on a variety of decisions that need to be made. Okay? Also, the stockholders have the preemptive rights. What does that mean? It means that, and this applies to all stockholders, even those who hold very small percentage in the company. It means that if you hold a certain percentage in the company, you cannot be diluted just because the company decides to issue more stocks. For example, let's say that General Electric number of shares is just 10 million. Okay? The current number of shares. And let's say that a specific investment, let's say James' number of shares in GE is 10,000. Okay? Which is 10,000 out of 10 million is 0.1%, right? So Jane holds 0.1% in the GE company. Now GE issues new, let's say 1 million shares. So GE cannot go to the public and sell it without approaching all of the current shareholders and give them the opportunity to purchase first at least the same amount of the shares in the company before they will be diluted in the sell in the public. Because if all of these 1 million shares will go to the public without asking Jane if she wants to buy, then this percent will go down, right? Because she still will hold 1,000 shares, but out of 11 million. So they must go to Jane first and offer Jane to buy how many shares? So GE must offers Jane to buy first how many shares? 0.1% of 1 million. Okay? To keep air shares in the company. So this will be 0.1% times the number of new shares, and this is 1,000. Okay? She doesn't have to. But the preemptive right gives us the opportunity to keep the same percentage of the company, 0.1%. Okay? So for those of you that bought stocks in the past, sometimes you get a mail or an email. Look, we have a new issue. Are you willing, before you go to the market, you want to buy. Okay? Then,
So how many shares can a company put out? Like,
as much as they want.
so they could put out a
You
billion?
don't have to buy. Right? But the company needs to convince you that it's something that you want to buy. Right? And usually when why the company issue stocks to begin with? Because they have some good project they want to invest. So they want to add more stockholders to the company, more owners, right? They can take a loan, but they also can say, look, we want to issue stocks. People that believe in the company, that the project will be good and will think that this is a good deal for them, right? If the company says, well, we just want to sell shares, but don't have any good project, the price will not be very good, right? So usually you issue stocks when you have some good place to put the money in, right? Okay, so sometimes when company go public, right, first time, then there is secondary public offering, right? And they issue more stocks and more stocks. Yes?
So this, the stock price like increases when the company doing something new.
When the company is asking the company issues stock when the price increases,
Yeah, when they're doing something new, or they need more money.
usually that's a good point, because if the market is efficient and there is no information asymmetry, everybody knows everything, then the price of the stock will increase when the company will have access to a positive NPV value, right? But sometimes the public doesn't know that, because the manager, Bill Gates, knows better than you and me what's going on in Microsoft, right? So we don't know everything. But if all of a sudden Bill Gates says, I want to issue stock because good things are coming to the company, it's a signal to the market that maybe he knows about good development, so information-based movement of the stock will go up. So that's a good question, and we'll talk about this when we're going to talk about market efficiency. Okay? And also capital structure when issue stocks and bonds. A good point. Okay? So this is a preemptive right. What does the stockholders get? As mentioned here already, when the company is profitable, it can reinvest the money back in the company, but also can pay the dividend, right? At the end of the day, at the end of the process, the owners want to enjoy the profits of the company. So the profits will go to the owners. And it goes to the owners in the form of dividends, paying directly to the shareholders. And the payments will be proportional to their share in the company. Someone that holds 5% will get 5% of the dividend. Someone that holds 10% will get 10% of the dividends. Okay? Now, is the dividend that is paid to the shareholder constant? Do shareholders get the same amount of dividend every period? Why not? Yes, please?
Because how much dividends will change from year to year, depending on what company they are, if they want to invest more in the company.
You pretty much said it all. It will depend on two things, basically, right? First, the level of earnings, right? If earnings are changing, if earnings are high, the firm more likely to have more dividends to pay. If the firm is losing or very low earnings, the firm can say, we don't have much to pay dividend, right? So this is one thing that makes the dividends vary over time. And another thing, you also mentioned whether the company wants to reinvest. Even if the earnings are very high, the company can say, wait, we don't want to pay dividend because we need the money instead of issuing new stocks to finance our new project. Right? So it's also a decision of the company. Okay? So dividends are not constant. Unlike the bond payments, the coupon payments that are constant. So this is why bonds are called fixed income securities, and stocks are called variable income securities. Well, the income from stocks are not fixed. Okay? And lastly, in case of bankruptcy, when the company doesn't have enough cash to pay the bond payments on time, who will get first the funds that are left in the company? The bondholders. And if something is left, it will go to the shareholders. So the shareholders are the residual claimants of the company. Okay? So these are a few fundamental things about stocks. And now let's talk about stock valuation. How do we estimate the price of a stock? When we think about a company, about the assets in the company, we can think about the company as books. Books that summarize the value of all of the assets in the company. And what specific book I'm referring to that's summarizing the asset? The balance sheet, right? You took the accounting class, so you know the balance sheet. So the balance sheet summarizes the assets and the liabilities in the company. So maybe we can use the numbers in the books to get some idea about the value of the stock. Let's see an example. So we have the balance sheet here. And the balance sheet has two sides, right? We have the assets on one side, and the other side we have the liabilities or the debt, right? So in one side we have what we own, and here we have what we owe, in a way, right? So let's take an example that the company has an asset of $10 million. And out of this $10 million, we owe $3 million. So this will be debt. So that means because of the balance sheet identity, right, that the asset equals, what is that? That was equity. The asset equals debt plus equity, then $7 million belongs to the equity holders. Right? So 10 million on both sides. Correct? So according to the company's book, the assets that belong to the shareholders are worth $7 million. So let's say that the number of shares in the company is, let's say 7 million, let's say 1 million. 1 million shares. So what will be the book value per 1 share? What will be the value of one stock according to the books? Take the 7 million, right, divided by 1 million. 7, right? So $7 million divided by 1 million shares, it's $7 per share. Okay? So we have an idea. The value of a stock according to the company's books, specifically the balance sheet. Right? Any problem with this measure? Let's say it's up to date. Let's say just report it. Reporting the balance sheet yesterday.
You could have a lot of assets, but if your cash flows are not good, then that could be a bad sign to the rest of the company.
But all of the cash flow effects already should be reflected in the balance sheet if it's up to date, right? So even if a lot of cash went out of the company, it will still be here. Yes?
the stock is outstanding?
What is it?
When the company not be able to sell.
Oh, okay, I see. That's a good question. Let's see. Everything is very liquid. You can sell and buy in secondary stocks. I agree. Some stock you cannot really buy, so there's some frictions in the market that may affect the stock price. But that's for simplicity. Let's assume that you can buy stocks. High-profile company is very easy. Sean?
I'm just gonna be a
Debt is here. It's a higher debt. It's here. Everything is, the debt is here. That's why it's in the 3 million. Are all of the assets that can generate future cash flow appear in the balance sheet? Are there any assets, valuable assets, that are not in the balance sheet? Assets that can generate future cash flow that are not in the balance sheet? Or everything is here? What do you think? Okay, I'll give you an example. Okay? Suppose we have two companies identical in all aspects, and the balance sheet of the two companies, it looks like this. So the book value is $7 for each company. Okay? But there's one difference between the two companies. Only one difference. You can say it's same industry, same country, same number of employees, whatever you want. The balance sheet looks the same. But there's one difference between the companies. Company A currently has great manager. Company B currently has lousy manager. That's it. Will that affect the value of the stock for you? If you go to the stock market, is it something that you will look at, or you're going to pay the same price for both companies? Yes?
You're gonna pay more for better management,
Why?
because they're gonna do better for the company and make it more profitable.
And you're going to get more dividends as stockholders, right? The better manager likely to make better decision, more profit for you. So you're going to pay more for the company with a better manager. Now, where is the quality of the management appears? In the balance sheet. Where? It doesn't. It's intangible, right? It's not physical asset, like machine or buildings or land or some accounts. It's intangible, okay? Another example. Suppose even the management quality is the same, but brand A is a very good brand name, and company B, not very good brand name. For which company will pay more? The company with a good brand name, right? But the reputation of the brand is not part of the balance sheet. So another intangible. Okay? Another example. Company A, the balance sheet is the same. Company A now have access to a project with very large positive NPV. Company B doesn't have access to that project. No cash flow came, they just have access. It's not in the balance sheet, but it's growth opportunity, right? So what is my point here? The balance sheet captures only part of the assets that the firm has, only the tangible asset, the physical asset, but it ignores all of the intangible assets, the asset that can still generate value to the firm, and that's why the investor will pay more for such companies. Okay? Yes?
Well, I know that Figma, the design company, just got bought out by Adobe.
And?
The acquisition was like $20 billion,
And?
which is a lot higher than the Figma usually would be worth it because they take up so much market share and the brand name is so valuable.
Excellent example. This is an excellent example. Okay? They bought basically the name of the company, right? And you can look at it, many new startup companies that don't have any assets, but they sold for billions because of the great brand name and growth opportunities, right? If you look at the balance sheet, is a tiny percent of the value of the company. So this leads me to ask you a question. If you look at the market value of a share, of a stock, and the book value of the stock, what do you expect to be higher? The market value or the book value? The market value, because the market value includes all of the intangibles. The book value includes only the physical, tangible asset. Yes, there may be also intangible liabilities. For example, if the company has pending lawsuit that is expected to pay a lot, it's also not in the balance sheet. But usually the intangible assets are much higher than the intangible liabilities. How do we know that? Because we compare the market value of the company to the book value. The market value for 99.9% of the firms is higher than the book value. Okay? Let's look at some, before we look at some examples, just two notes actually, that equivalently to the balance sheet, we have other measures we can look at other measures of the stock, value, but it's also based on the history, what the firm already has and not on the future. For example, liquidation value. What is liquidation value? Liquidation value measures the proceeds that the company will get if liquidate the company right now and selling all of the assets. And the company will not operate anymore. So yeah, it will sell off the machines, the land, the equipment, but brand name is not relevant anymore, and not the quality of the management, not the growth opportunity. Yes?
Could you repeat that, please?
Liquidation value? Yes. If a company right now stop operating and sell all of its physical assets in the market at market values, so the shareholders will get something, right? But everything that you'll get represents the tangible asset, the physical asset, because the intangibles will not be relevant anymore, right? Brand name, management quality, growth opportunity. So the liquidation value, like the book value, it's based on the history, what the firm has already, the assets in place. But it ignores all of the future growth opportunities. Another measure is replacement cost. If company A reached to a certain point and company B wants to reach to the similar point, then how much it would cost company B to purchase all of the equipment, all of the land, all of the machines just to be on that point, this is the replacement cost. But also look at all physical, tangible assets. So all of these measures are backward looking. Okay, they're not forward looking. And here is some examples of the comparison between book value and market value. The number is not up to date, but the ratios are pretty representative. So usually companies, Microsoft, FedEx, Ford. So look at Microsoft, for example, not up to date. At some point, the book value per share of Microsoft was 6.78, closer to the $7 here, based on the same metrics. But if you look at the market price, $26.31, almost 4 times the book value, which means that almost 75% of Microsoft is coming from where? From the equipment that they have? From the land, the machine? No. It's coming from where? From the brand name. From the trust of the investors that Microsoft will be able to innovate, right? To still produce products that will generate cash flows. And it's not reflected in the current physical assets. Ford, for example, also the market value is higher than the book value, but not 4 times more. Only by 1.6, this is the ratio. And this is expected or not that in the car industry, the market to book ratio is lower than the market to book ratio in the high-tech industry. It makes sense or not? Who said yes? Ethan? Yeah.
I think tech industries, they have a lot more than just physical assets. When it comes to the car industries, like what more do they have besides maybe equipment management or something like that?
In the car industry relies on equipment,
Exactly.
on heavy machines, on land, on factories, right? And although there's some innovation here and there, they stay on pretty much the same line of business, right? So there's still there is intangible. That's why the market value is bigger than the book value, but not 4 times like in the high-tech industry that is characterized by low equipment, low physical assets, and a lot of branding and innovation. Okay, so it makes sense. Overlook some other companies in between. Okay? Any questions? Yes.
With the Microsoft example, would like the onboarding of a really good technical engineer, software developer, would that be considered like an intangible asset?
I'm sorry, I didn't hear.
With like Microsoft or tech companies, when they're onboarding like really talented engineers.
Exactly. This is what you rely on. You know that Microsoft hired the very high quality engineers, programmers, right? And at some point they can produce new products that will be a big hit in the market. Yes, the brand name, the quality, the reputation. Exactly. And in the high tech, this is what brings the cash eventually. Okay? So in the high tech industry, if you look at other companies, it's very representative. The market to book ratio is very high there. Yes.
Is there ever a market to book ratio that's too high to where people are like, this is valued too high and we're gonna wait for the stock to drop to invest in it?
If you look at new companies, especially in the high-tech industry, the market-to-book ratio can be very, very high. Why? Because you have like a big innovation. You didn't produce any cash yet, and you have like basically one desk, one laptop, and one office. These are all of your assets. But you think about how much the company worth, it can be worth like billions. Okay? So if the market is efficient, I'm going back to this because if the market is efficient means that you have the right price, it indicates basically how much growth opportunities you have. If we deviate from the efficient market hypothesis, okay, and you look at 10 car companies, each one of them is 1.6 market to book ratio, and one have all of a sudden 4, then you say, wait a minute, this is suspicious. So either this car invented something, like Tesla or I don't know, or that you say, maybe there is overpricing a little bit. Maybe the market didn't get it right. Because how come Ford is 1.6 and another car company is 4? Okay, so if you deviate from the efficient market hypothesis, then you look at misprice. Okay? But if the market is efficient, it's reflecting the growth opportunities. So it's a good question, depends on where you are in the market efficiency opportunities. And we'll talk about it later in the course. Okay, but now we assume that this reflecting the growth opportunities. More questions? Okay. So balance sheets are generally backward looking. Okay, book values and the other measures, liquidation value, replacement cost, are backward looking only at the asset in place. Stock price reflect also all of the assets that can still generate future cash flows, or forward looking. So although balance sheet values give useful information about liquidation value or replacement cost, analysts must look to future cash flows to estimate the value of the firm as a going concern. Okay? The company is operating, generates future cash flows. What will be the stock price? And the stock price, therefore, will be estimated as all assets and projects that generate future cash flow. The value of the stock will be given by the present value of all of the future payments made by the stock. Okay? So this is where we are. What cash flows will be made to the stockholder? If you buy the stock, let's say you bought now a stock of a certain company, what are you going to get in the future? You're going to get the dividends every quarter, whatever, right? If the company is paying dividend. And then you're going to get the price of the stock when you sell the stock in the future. Agree? And if the stock increases, it's good for you, you made some profit. We call it capital gain. So basically your net profit will be the dividend that you get, your net cash, and the capital gain, right? Because if you pay 100, you get 110, you get another $10, right? Net. Make sense? Yes? So what do you get? You get the dividends and you get the stock price when you sell it. Agree? So you need to calculate the present value of those. Make sense? But there is a little problem here. And I want to volunteer here that, let me ask you this. You don't have to tell me the name of the stock. Anyone here bought a stock ever? Oh, good. So who wants to volunteer? Don't tell me the name of the stock. Remind me, I'm sorry. Mason. Think about the stock that you bought. You holding it right now? Mm-hmm. Okay. Don't tell me the name of the stock. But tell me the exact date that you're going to sell it. You don't know. Anybody knows here when the exact day they will sell the stock that you're holding? Why would we? We buy the stock, we are not obligated to sell it at some point. So this is a little problem, because if you want to calculate the price of the stock, the present value of the selling price of the stock, but we don't know when we're going to sell it, how are we going to do it? Right? So the dividends, maybe we can estimate, but we don't know when we're going to sell the stock. Right? So let's see how we can resolve this issue. So let's assume, consider investors who purchases a stock and plans to hold it only for 1 year. We intentionally assume this to see that it's not relevant when the person plans to sell it. Now, assuming the market price equal to the present value of all future cash flows, then what do we have? We have one dividend that will pay next year. Assume the person just bought the stock price after the dividend was paid. Jeremy, we'll start with you. You just bought the stock, okay? In 1 year, you're going to get a dividend of the stock, D1, and immediately you sell the stock. What will be the price of the stock? P1, okay? So you do some calculation. You said, okay, what should I pay today? I should pay the present value that I'm going to get from the stock. I'm going to get the dividend, so it works for me the present value of the dividend, D1 over 1 plus R, and then I'm going to sell it immediately at the price next year, P1. So we have a formula for P0, not a problem. We can estimate D1, not a problem. But where P1 is coming from? So we get rid of P0, but P1, we don't know what is P1. Yes?
But don't we know what P0 is? That's what we're investing now as the present.
No, before. I'm asking a question how investors come up with the P0. Right? The P0 is the price in the market. Why investors put this price in the market? Why the current price of Tesla is 308? Why? It's coming from somewhere. This is what we want to figure out. How to estimate this 308. Okay? So you do some calculation and said, okay, this is the next dividend, this is the price next year. But we don't know what will be the price next year. So you sell it to, remind me? The name?
Maria. Maria.
Maria. You're going to buy from Jeremy next year the stock price and you're going to hold it only for 1 year, okay? So you said, okay, P1, what you're going to get? You're going to get the dividend in 2 years and you're going to sell it to Jason in 2 years, okay? So you, next year, P1, next year the price will be the dividend in the second year, discounted 1 period from year 2 to year 1, right? Because this is the price next year. So you need to discount only 1 time. And then the price that you're going to sell it to Jason in 2 years, right? So now let's take this P1 here and plug it in here, because we have the P1. So what do we have? So P0 equals D1 over 1 plus R. plus, now we put all of this here in P1. So we have D2, so let's slow it. We have 1 over 1 plus R, D2 over 1 plus R plus P2 over 1 plus R, which equals to P0 equals to D1 over 1 plus R plus D2 over 1 plus R squared over P2 over 1 plus R squared. So we got rid of P1. It's not in the formula, but we have P2. So where is P2 coming from? We can do it again and again, right? So Jason, you're going to sell it to Robert after 2 years, right? And Robert is selling it to Paul after 3 years, and to Alexis after 4 years, and so forth. We can do it all, and every time he's going to do it, we're going to get another dividend, and the price will push, the annual price will push one period to the future. We can do it until when? This exercise conceptually until when? Infinity. Until the ultimate results that the stock price will be a function of only future dividends. And this is the important result. Okay? The stock price is the present value of an infinite series of expected dividends. Because every future price that you can think, oh, this will affect the price now, every future price is a function of future dividends. So we can convert it to future dividends. Okay? Even if the company doesn't pay dividends right now, at some point, someone in the future will enjoy the profits of the company. And based on that, the price of Tesla is 308. Or the price of Microsoft is 500, whatever it is. Okay? Make sense? So this simplifies things. Because if we want to know the price of the stock, what we need to do is to estimate the expected dividend of the company. Okay? Any questions? Okay. So in short, the sigma, the price of the stock is the present value for dividend from next year to infinity. And because, yes, question? And because the stock price is equal to the present value for future dividends, let's talk now about specific stream of dividends and how we can use the shortcuts to estimate the present value. So we start with a very simple case. It's called the zero growth. This is not very realistic, but we started to build to more realistic cases. What is zero growth? Instead of D1, D2, D3, and so forth, the company will pay the same dividend forever. Okay, D1, 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 D1. So what will be the present value of such constant amount of money forever? It will be the present value of the first dividend, the present value of the second dividend with the same dividend but different present value because the discount for 2 years, and so forth. But what kind of series is this? Geometric, infinite. We have a perpetuity here, right? A constant amount of money that runs forever, like the perpetuity bond. And we know something about the present value of a perpetuity, right? The present value of perpetuity equals C over R. Remember that? So if we have a reason to assume that the company will pay the same dividend forever, then the stock price of this company will be that dividend over the discount rate. Okay? This is the zero growth. Now let's go to the second specific stream of dividends, this is the constant growth. So we start with D1, but now D1 is increasing. We don't have D1, D1, D1. We start with D1, and then D1 is increasing to D1 times 1 plus G, so G is the growth rate. In year 3, D1 times 1 plus G squared forever. Okay, so we have a constant growth. G is constant. And this is more realistic. Okay, because companies are growing, and if you look at analyst forecasts, maybe in the first few years dividend is changing, but at some point, the analyst must assume some constant growth, right? Because other analysts cannot estimate different dividend forever. So we need to make some assumption, yes.
So I'm actually confused. So if the D is for dividend, G is for growth, what's the R?
The discount rate. It's how you discount the dividend. We didn't talk about how to find R, but this we'll do after the first midterm. When is the first midterm? What is the date today? What week are we?
Today's the 19th.
No, but what week of the course? The fourth week already? It's the fourth week. So the fourth week. So the first midterm should be on the 5th week. So the midterm will be on Wednesday next week. The first midterm. No, you know what? No, not on Wednesday. On Monday, 2 weeks from now. What? Yeah. Okay. Monday, 2 weeks from now. Okay. So yeah. Okay? So put in your calendars, and we'll talk about it before
It's
the...
October 3rd, right? Yeah.
Okay, so Monday, 2 weeks. Everybody here? Okay? On Wednesday, I'll say it again, and on Monday, I'll say it again. So first midterm, Monday, 2 weeks from now. So after the midterm, we'll talk about how to estimate the discount rate. But up to the midterm, I'm giving you the discount. Okay? So this is the constant growth. Now, the constant growth, what kind of geometric series is this? If you look at the present values, yes? Growing perpetuity, right? If you look at the present value, d1 over 1 plus r, then d1 1 plus g over 1 plus r squared and so forth, is a geometric series, right? Where the q is 1 plus g over 1 plus r. We're not going to go back to all of the geometric series. We did it, right? The first element is d1 over 1 plus r. And so we did it already a few times. The present value of a growing perpetuity is c over r minus g. Right? So the same thing here, if we start with d1, the present value of a growing perpetuity of a dividend is growing constant rate is d1 over r minus g. Okay? So we use the shortcuts to estimate the value of a stock that assumed to have dividends growing in a constant rate. Know that the growth, the same thing that we said about growing perpetuity, I'm going to repeat them here. The growth start in the second period, right? If the growth started in the first period, just write d1 times 1 plus g in the numerator. The first payment goes to the numerator, everything else is the same. The zero growth is a specific case of the constant growth, where g equals 0. And what do we know about the relation between r and g? Who is bigger? R or g? R must be bigger, right? Because the sum of the geometric series works only when q is smaller than 1 and we know that Q is 1 plus G over 1 plus R. If you take every present value divided by the previous one, this is what we get. So this is smaller than 1, only when R is bigger than G. And for stocks it makes sense, because stocks cannot grow forever at the constant rate, right? There's a limit to the growth of the company. Why there's limit? Because first competition kicks in, right? And also there's limit to the market share, number of clients, right? When Google started, it increases by a lot. At some point, it cannot increase by the same rate. Okay? So, example for the constant growth. Chevron Corporation will pay a dividend of $3 per share 1 year from today. The dividend is expected to grow at 10% per year. What is the dividend per share in the next years? So let's do this here.
Actually, we get to leave 2 minutes earlier.
What?
We get to leave 2 minutes earlier today.
Yeah.
All of you?
Yeah.
Why?
You don't remember last week?
Oh, I owe you some minutes?
Yeah.
How much? How many minutes?
Just 2.
Just 2.
I think 15, but I'm just guessing.
No. You know, I'll give you the reason that you could say there's a time value of minutes. 2 minutes and 30 seconds, maybe, but that's okay. So how many minutes left before? So we have 8 minutes left. Okay, no problem. No, that's fair. Okay, so we have here 0, 1, 2, 3. So we start with $3, right? This is D1, the first dividend. Then it goes by 10% a year. So here would be 3.3, right? 10%. Then we have 3.63. Then we have what? What is after 63? 99? Yeah, no. Check me on this. It's correct? This is correct, right? This 3.6, 3.6, the difference is, it's correct? Yeah, 3.99?
Yeah, people don't know.
Okay. Okay, so, and 4. Okay. I could skip the 4. It's the same thing, okay? So basically, assuming the discount is 15%, I give you the discount. What is the value of Chevron common stocks? So we know that this is a constant growth model, so the value of the stock, so P will be D1 over R minus G, which is $3 over 0.15 minus 0.1, and this is $60, right? $60, correct? Yes? Okay. Now, before moving on, an important point, because later on we'll estimate the growth rate. But for now, I want to show you that, give you some motivation that it's very important to get a good measure of the growth rate. The discount rate you already said, but also for the growth rate, because the constant growth model is very sensitive to the choice of the growth rate. And for example, suppose that the growth rate of Chevron was estimating with a mistake. So instead of the 10%, we would come up with 12.5%. Made a little mistake. With 10 and 12.5 doesn't seem like a huge deal, right? So instead of 10%, 12.5%, big deal. But what would be the price of Chevron with that mistake?
It would double.
A double, exactly. R minus G, now it will be $3 over 0.15 minus 0.125. And this will be double. Okay? So if you made a little mistake, you would pay twice as much for that stock, and you don't want that. So this to give you some motivation that the growth rate is very important factor in stock pricing. So we need to estimate it as accurate as possible. So later on, probably not today, but later on Wednesday, we will talk about estimating the growth rate. Where is the growth rate coming from? Now we can estimate it. Okay, but this is just to show you that it's very, very sensitive to the stock price. Few more things about the constant growth model. Okay? The constant growth model is also called the Gordon model, after Myron Gordon who first discussed it. And as we mentioned before, R is bigger than G, and as G getting close to R, the stock price will be high. Okay? But it cannot reach us to R because then we cannot use the shortcut. Okay? Okay, so we have 3 minutes. So what we're going to do here, give you some heads up for Wednesday. So we had 2 cases, the zero growth and the constant growth, right? And we said that the constant growth is more realistic than the zero growth because companies usually growing. But now we're going to talk in this third case, the third and the last specific case, and this will be even more realistic than the constant growth. And this is called differential growth. So what is the differential growth? Once again, I'm not putting all of the equation today, but give you some motivation. Differential growth means that the company is growing, the dividend is growing, but it doesn't grow at the constant rate all the time. There is a short-term growth and a long-term growth. So we have G1 and G2. So in the first number of years, the early years of the company, let's say from year 1 to capital T, the firm will grow at the constant rate G1. So we start with D1, then D1 times 1 plus G1, all the way to year capital T, G1, 1 plus G1 with the power of capital T minus 1. What happened between year T to year T plus 1? The dividend is continued to growing, but not at G1 rate, but rather at the G2 rate. So instead of 1 plus G1 with capital T, we have 1 plus G1 with power of capital T minus 1 times 1 plus G2, and so forth, forever. So a little bit of intuition here. Does this make sense that the company will have short-term and long-term growth rate? Why, Alexis?
With the different amount that it's growing, it grow a lot in the short term. It's a new
Think
company.
about typical company.
Yeah.
Is growing at the same rate forever? Where it's growing more, in the early years or the late years? Early years it grows at a higher rate. Why?
It's the newer company and like it's getting introduced to the public.
And it has more potential.
Yeah.
The reason that we said before, right?
Yeah.
Capturing more market share, right? If you look at Google, what was the growth rate in the first years? 50%, 80% a year. Now it cannot grow at 80% a year, right? But they capture most of the users, right? And also there's some competition. So usually we have higher growth rate in the early years and then lower growth rate in the late years. So on Wednesday, the first thing we're going to do is analyzing this case and what will be the value of the company in the differential group. Okay? So see you on Wednesday.